Okay, so for margin of safety. So margin of safety is the units sold or expected to be sold, or the revenue earned or expected to be earned above the break-even point. So meaning to say, this is just like the desired profit or target profit or income. So from the term margin of safety, meaning this is the number of units or revenues that we need to reach so that we can be above, or the company can be above the break-even volume. So which means to say that the company will now have its profit. So this margin of safety is like a security on the part of the company, because with this level of sales or number of units sold, they can be sure that they have or they will have a profit. Okay, so to illustrate, so we have here Blaze Boards Company plans to sell 10,000 skateboards. Okay, the same data actually from the previous illustrations. So our requirement is number one, calculate the margin of safety in units for the coming year. The second is you have to calculate the break-even point in sales and the margin of safety in sales for the coming year. Number three, what if the company actually sells 9,800 skateboards in the coming year? So we will again solve for the margin of safety in units and its sales revenue. Okay, for our solution, margin of safety. So our formula is number of units sold minus break-even point in units. Okay, so again, the number of units sold must be higher or greater than the break-even point to, or in order for the company to have a profit. So based on the data, so our number of units sold is 10,000. Our break-even point in units, this is actually what we have determined in the previous illustrations. Okay, that's 7,500 units. So our margin of safety is 2,500 units. So by the way, the break-even point in units was determined in illustration number 2. Okay, for the second requirement, break-even in sales. Okay, so we will use again the data provided. So that's 7,500 times our selling price. So our break-even in sales revenue is 3 million. Okay, so here margin of safety in terms of sales revenue is again sales revenue from the actual sales minus the sales revenue in sales revenue from break-even sales. So here our actual sales revenue is 4 million. Okay, that's 10,000 times 400. Okay, minus our break-even point in sales of 3 million. So the margin of safety in sales revenue is 1 million. For the third requirement, so here, what if the actual number of units sold is 9,800? So basically, our margin of safety will change from 2,500 to 2,300 units. And again, in terms of the margin of safety in sales revenue, so it also decreased from 1 million to 920,000. Okay, so again, please take note of our formula. I would like to repeat, margin of safety in units is equal to number of units sold minus the break-even point in units. For margin of safety in sales revenue, we have sales revenue from sales minus sales revenue from the break-even analysis. Okay, so then second approach to mitigate the risk and uncertainty is operating leverage. So when we say operating leverage, actually it has a what you call this basis from the science field, or the field of science. Okay, so actually when we say when we say operating leverage, or leverage, I mean, in science terms, we mean it's like a lever, meaning there is something that helps in pulling a heavy object. Okay, so lever. So here, in terms of operating leverage in a business organization context, we will use the fixed cost, okay, for our leverage to increase the profits. So, unfortunately, it is also true that firms with higher operating leverage will also experience greater reductions in profits as the sales decrease. So, therefore, operating leverage is the use of fixed costs to extract higher percentage changes in profits as sales activity changes. So, here, the greater the degree of operating leverage, the more the changes the sales activity will affect the profit. Okay, so the mix of costs that an organization chooses can have a considerable influence on its operating risk and profit level. So, the degree of operating leverage can be measured for a given level of sales by taking the ratio. So, our formula for degree of operating leverage is total contribution margin divided by the profit. Okay, so if fixed costs are used to lower the variable cost such that contribution margin will increase and profit decreases, then the degree of operating leverage increase, signaling an increase in the risk. So to understand better the concept of operating leverage, so we will use this illustration. Okay, for Shadra Company, so they are planning to add a new product line. So to do so, they can choose to rely heavily on automated or on labor. So the relevant data for sales level of 10,000 units are as follows. So given there for automated system and manual system. So for our requirement, so number one, we will compute the degree of operating leverage for each system. Okay, number two, suppose that the sales are 40% higher than budgeted. By what percent will operating income increase for each system? So what will be the increase in operating income for each system? And number three, what if unit sales are 30% lower than the budgeted? So what will happen with our operating income? So, and what will be the increase in operating income for each system? So for the solution, okay, for number one, the degree of operating leverage is equal to contribution margin over profit. For the automated system, its degree of operating leverage is 4. For the manual system, it's 2. Okay, second. So for the second requirement, suppose that the sales are 40% higher than the budgeted. Okay, so meaning we will just multiply the increase in the result that we have for the operating leverage to get the uh, difference or the change. So for the automated system, there is an increase in profit percentage, okay, for 160%. And for manual, that's 80%. Or if you're going to convert it into their sales revenue, so we will use the percentage and multiply it. So for automated system, there will be an increase in profit from 125,000 to 200,000. And for manual system, the increase is, the increase is 80,000. So next, automated system increase in profit is 160%. So there will be an increase by 200,000. So the new profit for system or automated system is 325,000, and for manual system is now 180. Okay, for requirement number 3, okay, so what if unit sales are 30% lower now? So of course, what will happen Okay, if we're going to uh, compare, basically it decreased, okay, based on the solution. So it follows that if the sales will decrease, so there will also be a decrease in the net profit, especially in our illustration for the automated system. Okay, so to break even point in units for the automated system, okay, so that's 7,500 units, or whereas the break-even point in units for manual is 5,000 units. So clearly, at the lower level of sales, the manual system is better, and at a higher level of sales, the automated system is better. So what is the sales level at which the manual and automated systems are equally profitable? So this is at 9,167. Okay. So next is for the sensitivity analysis and CVP. Okay, so when we say sensitivity analysis, this is taken into consideration the changes in the variables. Actually, this is the same as the changes brought about by risk and uncertainty. Okay, so here, the pervasiveness of personal computers and spreadsheets has made cost analysis within reach. So you can use the spreadsheets to solve for sensitivity analysis and not to compute it manually. So an important tool is, okay, sensitivity analysis. So this is a what if technique that examines the impact of changes underlying the assumptions. So it is simple to input the data on your prices, variable cost, fixed cost, and sales mix in the spreadsheet. And you can also set up formulas to calculate the break-even point and expected profits. So here, the data can be varied as desired to see what impact changes have on the expected profit. So in fact, in our previous illustrations, the what if requirements are actually the sensitivity analysis application. Okay, so we have here for the table that is related to our illustration a while ago under the operating leverage. So this is the effect of the sensitivity analysis. Okay, so what will happen if there will be changes? Okay, so next, CVP analysis and non-unit cost drivers. So the conventional CVP analysis assumes that all costs can be divided into two categories, variable and fixed costs. So further, costs are assumed to be linear functions of sales volume. However, there are costs that vary with non-unit cost drivers. So cost drivers, by the way, is related to your activity-based costing or ABC system. Okay, so this is cost drivers are the factors that causes the increase of the costs for each activity. So in this, costs are divided into unit and non-unit based categories. This is actually part of your cost management and control. Okay, if you could still remember. So here, a good example of this is some costs, such as setting up production of the equipment, vary with the number of batches. Other costs, such as purchasing and receiving costs, may vary also with the number of different products. So, in conventional CVP, those non-unit variable costs are assumed to be fixed because they do not change as to the number of units and activities. However, CVP can be modified to take account of this set of variable costs. So this type of modification can make CVP even more useful since it will provide more accurate insights concerning the cost behavior. So of course, these insights will produce decisions. Okay, to illustrate, Assume that a company's cost can be explained by three variables. We have unit level, cost driver, the units sold, a batch level cost driver. So this is the number of setups, and the product level, which is the engineering hours. So we have three. Again, unit level cost driver is the number of units sold. For the batch level, this is the number of setup, and the product level cost is engineering hours. So the cost equation can be expressed as follows. So you can see that in your module as well. Operating income, as before, is the revenue or the total revenue minus total cost. So this can also be expressed as follows. Okay, so incorporating the company's costs based on or under the ABC system. Okay, so a comparison of the ABC break-even point with the conventional break-even point reveals two significant differences. Of course, first, the fixed cost will differ. Some costs previously identified as being fixed may actually vary with non-unit cost drivers. So in this case, setups and engineering hours. Second, the numerator of the ABC break-even equation has two non-unit variable cost terms. There is for batch-related activities and for product-sustaining activities. So that the formula is also presented. Okay, so we have here an example comparing conventional and ABC analysis. So to make the previous discussion more concrete, so we will compare conventional cost or CVP analysis with activity-based costing. So let's assume that the company wants to compute the units that must be sold to earn a before-tax profit of 20,000. So the analysis will be based on the data. Okay, so you can also see that in your module. Okay, so the units that must be sold to earn a profit or before tax profit of 20,000 is as follows. Okay, so our formula is targeted income plus fixed cost divided by your contribution margin. So that's 12,000. So that is for the conventional CVP analysis. What about under the ABC equation or system? So here, using the equation that we have presented earlier, so the units that must be sold to earn the operating income of 20,000 are as follows. So again, all you have to do is just follow the prescribed formula. So here, it's also 12,000. Okay. So that's all for our module 1. For our reference, so the content of this module was based from the book of Hansen and Moen, Strategic Cost Management. Okay, this is 2019 edition. As well as from Cabrera, Strategic Cost Management. So that's all for our module number 1, cost, volume, profit.